Welcome, everyone. We're so glad you can join us for this on-demand year-to-date economic report and investor outlook webinar hosted by JFL Total Wealth Management. The first quarter of 2022 left even the most seasoned investors weary of the turbulent financial markets, and the months of April and May haven't brought any relief. An estimated $11 trillion has been erased in the global markets since the end of March. Today, JFL will review market returns year-to-date, historical comparisons, what you can expect in the coming months, and steps you can take to better protect your investments and finances in a volatile market. Without further ado, let's introduce our two panelists. Jeanne Kane has an MBA from Duke University and is a certified financial planner. She has extensive experience analyzing and managing our private clients' portfolios and with developing comprehensive financial plans. Jerry Lynch is a certified financial planner and has been an independent financial advisor for 25 years, working in the financial industry for more than 30. Welcome.
Welcome, everyone.
Welcome, everybody.
All right, Jeanne, do you want to get us started and talk about what we're going to review and kick it off?
Yeah. Thanks, Gretchen. So today we're going to provide a year-to-date market review, and then we'll shift gears and talk about our economic outlook for the coming months, and really what can you expect as an investor, and what can you be looking forward to do for the rest of the year. So let's jump into the year-to-date market review. What a whirlwind it's been so far this year. Just when things started to feel like they were going to get back to normal, the world was thrown another hardship and another hiccup as Russia invaded Ukraine. For investors, this added more fuel for market volatility. Couple that with inflation and rising interest rates, the first few months of 2022 were a roller coaster ride for the equity markets. The stock markets had their worst period since the start of the pandemic in the first quarter of 2020. Now, let's look more specifically at the war. How would this potentially impact you? Well, the first place it could impact you is in energy security. And this is no longer just a discussion about climate change. The war in Ukraine has shown how the energy supply is also related to military security. The US and Russia are the world's largest producers of natural gas. And US is now a large exporter of liquid natural gas to Europe because of Russian sanctions. This ultimately is going to increase our electricity bills back at home. Supply chains are another area, and this has been a major issue really since the start of the pandemic. And again, just when we think things are starting to get better, parts of the world, such as China, are in lockdown again. Add to that the US ended permanent trade relations with Russia. So they're not our largest trading partner, but in 2019, the US imported $22 billion of goods from them. And then finally, food insecurity. Wheat crops in Ukraine and Russia have been disrupted. The two countries, they account for 30% of the world's wheat. And in March of 2022, the US and other producers banned the export of wheat and oats and other staples to avoid humanitarian crises at home. So it may be harder and more expensive to find certain types of products in the future. If we could use one word to describe the markets since the start of this year, that word would be volatility. The equity markets experienced several significant drops during the first quarter. The US stock markets produced their first losing quarter since March of 2020. And year to date, the S&P 500 is down 17.68%, and the Dow Jones Industrial Average is down 13.34%. And despite rebound in markets in April, May stock prices have been impacted by continued uncertainty around inflation, rising interest rates, and the war in Ukraine. And tech stocks have been particularly hard hit in May. And in fact, the energy giant Saudi Aramco overtook Apple as the most valuable company in the world. That happened in May 11th, really due to tech's kind of decline and the run up in oil prices. Now, if we look at annual market returns, they tend to be unpredictable, but the up years, if we look in our chart, the green years here, those occur more frequently than the down years, or the red on our chart here. The US stock market posted positive returns 75% of the calendar years from 1926 through 2021. And during that time, the average annual return was 10.2%. So the down years, those are fantastic times to be systematically investing. If you're participating in a 401k, this is a wonderful time for you to be having that money systematically go into your 401k. Another noteworthy trend, more than 2/3 of the down years, those were followed by up years. The most recent example we have of this is from 2018. 2018 had a 5% loss on the year, and that was followed by a 30.4% gain in 2019. Now we'll shift gears here and talk a little bit about inflation. Inflation is a decrease in the purchasing power of money. So you'll see it in the increase in the prices of goods and services in the economy. And if you've been to the grocery store or filled your gas tank lately, you know that inflation is out there. Now, the US's annual inflation stayed near a 4-decade high, declining only slightly to 8.3% in April from 8.5% in March. However, upward pressure remains. And inflation is not uniform across sectors. Gas, energy, used cars and trucks, those had the highest 12-month change in prices. Whereas if we look at services and shelter, clothing, those are on the low end of those 12-month gains. But just note, just because the sector falls below that average, prices are still rising. Those services that are right near the bottom, those prices rose 0.7% from March to April. That is the fastest one-month increase since 1990. Now, in terms of interest rates, the Federal Reserve raised the federal funds rates in March and then again in May. And these were the first rate increases since 2018. In May, the rates were increased by 0.5%, and this was the sharpest increase since 2000. Now, there are more interest rate increases anticipated this year, and they're anticipated to really help tamp down inflation. So what can you expect? How can the higher interest rates impact you? Well, first, if you are looking to buy a new home, mortgage rates, these higher rates are going to mean it's going to be more expensive for you to borrow. And if interest rates go up by 1%, you'll pay $80 more per month per $100,000 that you borrow. Now, an average 30-year fixed rate mortgage was 5.48% for the week ending May 13th. A year ago, that same rate was 3.38%. Look into locking in a fixed rate mortgage. Adjustable rate mortgages, those are becoming more popular. You're starting to hear more and more about those. And if you're interested in this type of mortgage, you really need to be sure you understand the details, because these types of mortgages caused a lot of problems for many homeowners during the housing crisis. Your credit card rates, those could be jumping up if they haven't already. Higher interest rates often mean that credit cards, they're going to have the higher annual percentage rate, that APR. Keep a close eye on your balance and the rate being charged by your company. But even better, pay off your credit card balance each month. Now, if you're looking to buy a new car, those auto loan rates are also tied into the Treasury rates. So it isn't a surprise to see that the rates are increasing there. Because of supply issues, cars are selling at or above the manufactured suggested retail prices. Combine these two factors and they're making it more expensive to buy a car. So really need to do the math before you buy. And then finally, looking at student loans. The federal subsidized and unsubsidized loans, those are reset annually and are fixed for the life of the loan. We can really see and anticipate a higher rates coming when they come out later this month. Now, if you have private loans, those can either charge fixed or variable rates. And again, those will depend upon the institution that you borrow from and then your individual financial circumstances. So if you're using these types of loans, you're also going to be facing potentially higher rates as well. So bonds and interest rates, those move in opposite directions. When interest rates rise, existing bond prices tend to fall. And conversely, when interest rates decline, existing bond prices tend to rise. Recent times have not been very, very beneficial for bondholders. Bonds are really considered in many circumstances to be more stable than equities or stocks for investors. This year, however, volatility in the bond market has been high, and the US bonds have had their worst quarter in over 40 years. So have you seen what interest rates are being offered by banks these days? These safe investments, they come at a cost. In finance, there's a calculation called the Rule of 72, and it tells you how long it will take for your money to double. If you invest in a brokerage account and it returns 7.2% per year, your money will double in 10 years. However, if you invest money only in a money market today, those are paying 0.08%. This investment would take 900 years for it to double. Now, if you put your money in a CD paying 0.24% in interest, that's going to take you about 300 years to double. Now, recall I mentioned earlier that inflation was 8.3% in April. If you're invested only in these types of conservative investments, you're effectively losing money. And that's because your investments are not keeping up with inflation. So this really highlights the importance of being diversified and having a diversified portfolio. Now, say you're someone who's feeling very concerned about the market being down. You say, wow, I want to try and get out of the market. Well, there's no proven way to time the market. So history suggests staying put through good times and in bad. So if we look at the impact of, say, missing just a few days in the market, it can be profound. So say we put $1,000 in the S&P 500 in 1990. That hypothetical $1,000 turns into $20,451 30 years later. If you missed the S&P 500's 5 best trading days, your return will dwindle to $12,917. If you miss the 25 best days, it'll drop to $4,376. So missing only a few days of strong returns, that can have dramatic impact in overall performance. And the best performance days tend to follow the worst performance days. So I'm going to turn this over to Jerry right now, and he's going to talk about the investor outlook.
All right, so everybody's asking what's going to happen this year. And let's kind of take a very quick look. In 1954, there was a recession in the United States. There was a gentleman named Sir John Templeton. Templeton Funds is the company that he started. He was a very good investor. And he basically came out with the 4 most dangerous words that any investor could say. And those are, this time is different. Now, if you take a look over your lifetime, we've experienced 2000, Black Monday, 9/11, 2008, and March of 2020. Those are some really big dips that we had. In spite of that, the market recovered and it did very well over a period of time. Now, basically where we are right now is in a mid-market correction, mid-cycle correction, which is basically it happens about 67% of the time. When there are corrections, it falls into this, which is between a 10 and a 20% decline in the market. The average drawdown is about 13%. Now, generally coming out of these, you see a 26% increase within a 12-month period of time. Now, even if we go back to March of 2020, in April through May, you saw a huge increase in the market. And for those of you who got out and moved into cash and didn't get that, you never recovered from that. So I think the key here is that in order to get consistent returns, the approach that you take has to be consistent. Okay, so this is probably one of the most confusing pages ever invented, but I like spending some time and talking about it. So if you take a look year to date at commodities, which is that in the upper right-hand corner, that green, it's 26% year to date, best performing asset class. 3 years and 4 years ago, it was the worst performing asset class and the second worst performing asset class. If you take a look at REITs, which in 2021 was up 43%. The previous year, it was the worst performing asset class that was out there. And even if you take a look at 2017, emerging markets was #1, and the previous year, it was the worst performing sector that's out there. What does this mean? It means a lot of people are asking us right now, where should we be with our money? And my thoughts are, let's spread it out. Let's rebalance portfolios. Let's make sure that we're exposed to the different areas, because we're never sure what area is going to be the hot area of next year. That's part of the nice thing about us working with our investment models, is it gives us the ability to give a predictable, stable return, even within a volatile market. Now, again, the questions that are people asking us for 2022 is, what should we be doing? And number one is review all income producing investments. What's the duration of bonds? Are there things that we need to be doing differently? We've recently made some changes within our portfolios to ultra short duration bonds, which do better in a rising interest rate market. And again, as we see things that need to be changed, we're going to make those changes. Number two, Jeanne said this before, if you got an adjustable rate mortgage, lock it in. Get that thing fixed for a period of time. The nice thing about inflation is, think about that. Inflation in the past year was 8.5%. If you had a 4% mortgage, your cost after tax, after inflation was negative. You're paying with future dollars that are worth less. So inflation actually helps with a fixed interest mortgage because it basically reduces the cost of being there. Number three, always maintain your liquidity. The tortoise always wins. Have money in a bank account. Assume bad things happen. If you lose your job, if something happens where you need to help a family member, being liquid and not having to sell investments when they're down is the most important thing. Reevaluate and confirm your cash flow needs. Take a look at where you're spending your money right now. Like Jeanne was saying before, certain areas of the economy were hit worse because of inflation than other areas. When you take a look at your spending, are there areas that you could focus some of your money on that are lower inflation costing areas? That might be something that makes sense. And then also, let's take a full look at everything that you're spending. How's the financial plan working? In spite of the market decline, are we still in line to be able to hit everything that we want to hit? I think the most important thing when you're involved with volatility in the market, take a step back, focus on what it is I'm trying to accomplish, what's the ultimate goal here, and make sure that based on what you're saving and where you are at that moment in time, you could continue to be in a lifestyle that you've become used to. So first of all, we just recently sent out an economic update. I want to make sure that everybody got that. If for some reason you didn't, please let me know. And just kind of in closing, I just want to talk about a few points real quick. We've been doing this now for 25 years. In 25 years, and actually 10 years before that with another firm, in 25 years, we've never had a retiree have to go back to work. And that's what I hang my hat on. There's retirees that went to work because they enjoyed it, but they didn't have to. And that means that the plans that we have in place are working successfully in spite of 2000, 9/11, 2008, and March of 2020. It works. We assume that these things are going to happen. So first of all, the equity market is still experiencing volatility. And I would assume that at least for the next year, year and a half, we're going to have supply chain issues, which means that products are going to take some time to get to market, which means that we're going to have inflation. We have a lot of people wanting to buy stuff, such as cars. You don't have that many cars, but you got people with money that want it. So you're going to see some volatility that's out there. Number two, interest rates are on the rise. Again, I would assume it's going to continue at least for the next year, year and a half. That's the Fed's way of putting downward pressure on inflation. And you're going to see that happening over and over again until we get a handle on this stuff. Number three, inflation is an all-time high. Again, it's big and it's not going away, at least until some of the supply chain issues that we have get fixed. The war in Ukraine is affecting natural gas and oil coming from Russia, as well as grains coming from the Ukraine. So again, we're going to have this. This is going to be like this for a period of time. That's fine. There are many factors that can affect the direction and the economy and the markets. Again, a lot of times people try to put these things together with 20 or 30 different variables and try to come up with the best possible solution that's out there. And my point would be is when you have that many variables, you can't get a reasonable answer on this. You need to make sure that you're approaching it in a conservative manner. You're assuming that bad things are going to happen, and you have a plan B and a plan C. And focus on your own personal goals and objectives. Again, don't care about what's happening in the market. Care about what's happening in your plan. Are you liquid? If something bad happens to you in a position where you don't need to sell stocks, am I investing on a systematic basis? Am I doing all the things right? So just a couple of things I would say is that when I first got out of college, my first job was selling vinyl siding door to door, which is the worst possible job that anybody could have. We would get people to use a home equity line of credit at 18% to pay for the siding. Okay, interest rates are rising, nowhere remotely close to where we are there, and things got better. And if we take a look at, we've gone through market declines of 2000. And if I could go back in time and change one thing that I did in the past, I would go back with a bucket of money and I would go back to 2000 and dump money in, 9/11, dump money in, 2008, dump money in, 2020, March, dump money in. Those were the best times to be investing in this type of market. And a lot of times it's scary because of the volatility we're seeing, but the market goes up over a period of time. We need to take a very long-term approach to this. And one other point I would make is the great Wayne Gretzky was one of the best hockey players that ever played. And he was asked why he was better than everybody else. And his response was very simple. I skate to where the puck is gonna be. Others skate to where the puck is. And a lot of times with investing, people have a tendency to focus on what's happening now. And to be perfectly honest, that's not my primary concern. My primary concern is where reasonably is the market going to be 5, 10, 15 years from now. And I feel very comfortable that it's going to be substantially higher. So a couple of things. Number one is, what can you expect from us? It's regular communication, such as this. When we see issues that are out there, we want to address it, whether it's on a video, an email, or just one of the newsletters that we have coming out on a systematic basis. Expect frequent discussions on a lot of the stuff that's happening that impact you in a positive and negative way. And then number 3 is expect us to be doing consistently our financial reviews. In these types of markets, I want to make sure you're okay. I want to make sure your cash flow is in a good position. I want to take some time and review your position with you so that you know what's good and areas that maybe we need to focus on a little bit more. Now, as I mentioned before, we've been doing this for a long time. We just had our 25th anniversary. We appreciate working with you. We thank you for all the support that you've given us over the years, and we are here for you. Thanks again, and have a great day.